In 18 months, Micron shed $40 billion of market value. The single pricing error that started it all went unnoticed until it wasn't. Micron Technology was once the darling of the semiconductor world, a key supplier of DRAM and NAND that powered everything from smartphones to data centers. When the stock tumbled, thousands of employees saw their 401(k)s evaporate, pension funds lost billions, and institutional investors watched their portfolios crumble. For anyone with exposure to tech, or simply a savings plan tied to the market, Micron's collapse is a cautionary tale about how quickly a market leader can become a cautionary headline. The factors that drove Micron's downfall, over-reliance on a single product line, aggressive forecasting, and a failure to heed macroeconomic warnings, are the same pitfalls that can trap any investor or founder. So how did a company with $30 billion in annual revenue slide into a $40 billion market cap implosion? The rise, riding the memory wave in early 2023, Micron posted record revenue of $31 billion, driven by a global surge in demand for high-bandwidth memory needed for AI workloads. Its stock peaked at $115 per share, giving the company a market valuation of roughly $120 billion. Analysts praised its aggressive expansion into 3D XPoint technology, and the company announced a $10 billion capital expenditure plan to build a new fab in Singapore. The narrative was simple: data is exploding, and Micron was the engine. The warning signs: overcapacity and price pressure, but under the surface, cracks were forming. By mid-2024, DRAM inventories across the industry swelled to 15% above the 5-year average, a level not seen since the 2011 memory bust. Competitors in South Korea and Taiwan were ramping up production, while Chinese manufacturers, buoyed by government subsidies, began flooding the market with lower-priced chips. Micron's own supply chain reports flagged a softening price environment, yet the board pushed ahead with the Singapore fab, betting on a sustained AI boom. But it gets worse. The turning point: the Q2 2025 earnings miss in August 2025. Micron released its Q2 results. Revenue fell 12% year-over-year to $7.2 billion, and the company announced a $2.3 billion write-down on DRAM inventory that had been valued at twice its market price. The press release stated, "We are adjusting to a new pricing reality." The stock opened at $88, a 24% drop in a single day. Analysts called it a price shock that caught everyone off guard, and the SEC began probing the company's inventory accounting practices. The collapse, a cascade of bad news within weeks. Credit agencies downgraded Micron's rating from A to BBB+. The company announced a 10% workforce reduction, about 500 jobs, citing excess capacity and the need to preserve cash. In November 2025, a major customer, a cloud services giant, announced it would shift 30% of its DRAM purchases to a competitor offering lower-cost alternatives. Micron's share price fell below $60, wiping out roughly $40 billion of market value in less than a year. Here's what they missed. The board's decision to proceed with the Singapore fab became the final straw. Construction costs ballooned to $12 billion, and the plant's expected startup was pushed from 2026 to 2028 due to supply chain delays. Investors demanded answers, and the CEO, Sanjay Mehrotra, resigned in February 2026 under pressure from activist shareholders. The aftermath: restructuring and legal fallout. New leadership under interim CEO Lisa Su, formerly of AMD, announced a strategic pivot: cut the Singapore project by 60%, focus on high-margin NAND products, and sell off a non-core 3D XPoint business for $1.5 billion. The company settled a securities lawsuit for $350 million, paying investors who claimed they were misled about inventory risks. By mid-2026, Micron's market cap stabilized around $80 billion, still 30% below its 2023 peak, but the company was finally on a path to profitability. That was the easy part. The broader market felt the ripple. Tech ETFs that held Micron experienced a 7% dip, and pension funds with heavy semiconductor exposure reported $2.4 billion in unrealized losses. The episode sparked a wave of congressional hearings on supply chain transparency and prompted the SEC to issue new guidance on inventory valuation for high volatility commodities. So what can we take away from Micron's collapse? Lesson 1. Never ignore macro-level inventory signals. When industry-wide stockpiles rise, price pressure follows. A simple inventory-to-sales ratio can tell you when a market is overheating. Lesson 2. Diversify product lines and geographic risk. Micron's heavy reliance on DRAM left it exposed to a single price cycle. Companies that balance memory with logic or specialty chips fared better during the same downturn. Lesson 3. Align capital expenditure with realistic demand forecasts. The Singapore fab was a massive cash drain that made sense only in a perpetually bullish AI market, a scenario that never materialized. The executives at Micron didn't set out to lose $40 billion. They believed in a technology trend that turned out to be more volatile than expected. The difference between their fate and yours is awareness, and that's exactly why you're here. If today's story made you rethink how you evaluate tech stocks, consider a platform that gives you real-time risk metrics and low-fee trading. Webble. Sign up through the link below for a free 90-day trial of commission-free trades and a $100 bonus credit. It won't eliminate every mistake, but it's a solid tool for staying ahead of market swings. And if you crave more deep dives into the biggest financial disasters, what went wrong, why it mattered, and how to protect yourself, hit subscribe. We drop a new breakdown every week, and you won't want to miss the next one. Criminal or just reckless? Tell me below. Save this so you don't forget it.